In this video, I'm going to cover evaluating special offer decisions. Okay, we can look at the following example. Let's see. Let's look at this. Let's say we typically sell our units for $10 per unit, and the variable costs per unit are, what is that? 350, 570, 660. Our variable manufacturing is 660, and therefore we have a contribution margin of 340. Then we have fixed overhead. Okay, so not really sure how many units we're selling in total, but here is looks like we're selling 100,000 units. So if I have 60,000 in total fixed overhead and I typically sell 100,000 units, then the per unit fixed cost is 60 cents. And then I have 80,000 in fixed SG&A. And if I sold 100,000 units, my typical per unit SG&A is 80 cents. So total fixed expenses are going to be an additional $1.40. All right. So I think what we're saying is that the total cost to produce one unit is $8. What if somebody came along and offered us, they said, hey, you know what? We have this special situation taking place. We need a bunch of units for our overseas affiliates. We're never going to buy from you again. You have all of this excess capacity, we understand, and we're willing to purchase every unit for $7.50. Should we say yes? Should we say yes? Somebody is offering us $7.50 to buy 10,000 units, maybe, and our total all-in cost to make one unit is $8. Should we say yes? I think intuitively most of us would say no, we should not, because it costs us $8 to make a unit, and they're only offering us $7.50. However, I was suggesting that there is excess capacity, meaning there's some part of the year where we're sitting around and we're doing nothing. And if we're sitting around doing nothing, whether we accept this order or not, we are going to be incurring our fixed costs. Okay? And so, man, when I'm thinking about a special order, the only thing I'm really focused on are the incremental expenses of saying yes. And in this particular situation, what we're saying is the variable costs of manufacturing this product are $6.60. Therefore, if somebody were to offer us $7.50, we would actually be making some money, right? Because it only incrementally costs us $6.60 and we would sell for $7.50. So we could theoretically say yes. Now, the risk of saying yes is that, man, if one of our existing customers found out that we were selling our product for $7.50 when they were traditionally and continuously paying 10, one of our existing customers could get upset and we could end up rocking the boat, so to speak. So we may not always want to say yes just because we can make money. But in general, right, those are things we want to think about. So companies sometimes receive special offers at prices lower than normal selling price. We just went through that. The decision to accept special offers should be based on the income effects right? And I would just say not always necessarily just the income expense or effects. But the general rule is if we increase income, then we should accept the order. So, new scenario, Fast Track should accept the offer to earn additional income of $18,000. Okay, so what we're saying in this particular scenario is somebody came along and offered us $8.50. And in this particular situation, right, the variable cost per units are still the same. That still looks like it is 660. Then they are saying that there are no additional fixed costs. However, they are saying that there is $1,000 in fixed SG&A. So maybe it's the case that to process the order, to send the packaging out, it's going to cost us $1,000 for this entire order. If I have an idle capacity, right? I think I'm still saying yes because we're paying or we're going to receive $8.50. We're going to incur 660 in manufacturing costs and then another 10 cents in fixed SG&A or incremental SG&A. So the income per unit is going to be $1.80. Obviously, I've already looked at these slides and I know that we're selling 10,000 units. Okay. And I also know that our facility is idle. Now, if our facility wasn't idle and we had no additional capacity, then I would not sell a special order for 850 if my typical price was 10. Because if I'm typically receiving 10 and I have no additional capacity, I would have to shut down the facility, stop making some of my traditional products, and then do this special order where I'm only making $8.50 per unit. That doesn't make any sense. In this particular example, though, since I do have an excess capacity, even with the additional $1,000 in fixed SG&A, I still think I'm going to say yes because $8.50 is more than the cost per unit to manufacture and produce this particular order. So I'm saying yes.